As the fall of 1992 unravels, the warmth of a spent summer still lingers, yet the sterling is in freefall, plummeting beyond freezing point. At the vortex of this turmoil stands a solitary figure, a man who orchestrated one of the biggest financial heists of the 20th century and earned the moniker, the man who broke the Bank of England. This is the story of George Soros, the legend who harnessed his difficult past to forge the Quantum Fund, one of the most successful hedge funds in history, and secure his status as the greatest speculator of all time. Born into a prosperous Jewish family in the heart of Budapest, George was the son of Tivadar Soros, a man who had tasted the harsh realities of life as a prisoner of war during World War I, and spent 3 grueling years on the run in Siberia. George once discussed his father's time as a wartime captive, explaining, "He went through a horrendous experience, and that taught him a lesson which then came in very useful. He, in turn, taught me a lesson which came in useful to me, which is the art of survival." By the time George was born, Tivadar had transformed his life, becoming a successful lawyer in Budapest and a strong pillar of his family. Early on, Tivadar imparted the lessons of resilience and survival to young George, lessons that would soon become his lifeline, not just in his stormy childhood, but in his future career as a speculator. In 1933, the world watched as Adolf Hitler ascended to power, and by spring 1944, the iron grip of Nazism had seized Hungary. As fear intensified and weaved a dark web over Europe, George's father, determined to protect his wife and kids, moved them from one hiding place to another. They adopted false identities, falsified papers, and even bribed authorities. To hide their Jewish identity, Tivadar changed his family's last name to Soros, inspired by the Esperanto word sori, meaning to soar. Ironically, this fresh alias would take on a deeper meaning as George's success would rise to unprecedented heights. Finally, when the war ended in 1945, George and his kin were able to make their way to Budapest. However, their lives were forever marked by experiences of the war. In a surprising twist of human resilience, George described his time under the Nazi occupation as the happiest time of his life. For young George, each day had felt like an exciting journey, akin to living out the plot of Raiders of the Lost Ark. He recalled, "Not only did we survive, but we managed to help others." However, the end of the Nazi occupation brought no relief for the rest of the country or for George's family. Instead, it marked the beginning of another nightmare, the Russian occupation, beginning in 1945. At this time, Soros's mother was raped by 2 Soviet soldiers in broad daylight, an incident that deeply scarred young Soros and led him to search for a better life elsewhere, rejecting the scars of his brutal past. In a heart-to-heart talk with his father, the young George revealed his yearning to leave Budapest. His eyes were set on 2 different horizons: Moscow, drawn by a curiosity to understand the machinery of communism, and London, lured by the BBC. Tivadar, his life heavily marked by the scars of communism, assured George that he could provide all the lessons he needed about the system's harsh realities. After a handful of lengthy conversations the two had, George was left with one clear choice: London. So, in the year 1947, 17-year-old George Soros found himself on a journey away from the iron fist of communism that had clenched Budapest. His mission was to understand the world beyond the Iron Curtain, and in doing so, discover himself. But after arriving in London, it became clear that George's success would not be immediate. He found himself penniless and alone, an outsider looking in. It was in this new city that George first discovered what true loneliness felt like. He found work as a waiter, surviving on leftovers from customers to fuel his dreams of receiving a solid education. In 1947, George Soros found himself stepping through the doors of the prestigious London School of Economics. These hallowed halls quickly became his haven, filled with the echoes of intellectual giants like Karl Popper, whose teachings would shape Soros' worldview and future investment philosophy. Most notably, Popper's revolutionary concept of falsifiability had a profound impact on Soros. This philosophical perspective would significantly shape Soros' understanding of the stock market's workings, though he wasn't aware of how just yet. Soros was a solitary figure throughout most of his education, his existence revolving primarily around his academic pursuits. By 1951, Soros had earned a BSc in his favorite subject, philosophy. However, the financial burden of graduate school was heavy, and it forced him to divide his time between his studies and laborious jobs. He found himself serving tables and working as a railway porter to keep his dream alive. But Soros was determined, his tenacity rewarded with a Master of Science degree in philosophy in 1954. Influenced by his mentor Karl Popper, Soros was resolute in his ambition to become a philosopher post-graduation. However, this first and foremost required financial stability. George's plan was to amass a sum of $500,000 over a span of 5 years, which he assumed would be enough to sustain his career as both a writer and philosopher. On a quest to secure his financial future, Soros turned his gaze towards the world of finance. He penned letters to every managing director of every bank in London. His persistence paid off when he landed a job at Singer & Friedlander, a well-respected merchant bank. Before long, Soros immersed himself in the world of arbitrage, exploiting price differences for profit. During this period, international trade was heavily concentrated on gold and oil stocks, necessitating a particular kind of currency known as premium dollars. While official exchange rates were set in stone, the currencies utilized for capital transactions would vary beyond the official range, driven by market forces of supply and demand. Soros's trading abilities swiftly garnered the notice of his co-workers, with one proposing he take up a role at his father's brokerage firm, FM Mayer, located in New York. George saw this as a chance to grow his income and take one step closer toward his dream profession, philosophy. So, Soros left his position at Singer & Friedlander and set his sights on the promise of the American dream. At the time, he was only 26 years old. This is how, in 1956, Soros landed in New York City, where he took on roles as a trader, security analyst, and salesman. While he hoped this would be his big break, the world of finance was not easily tamed. During the formation of the European Common Market, there was a surge in interest in European securities, a world Soros quickly became immersed in. This lucrative venture, however, was halted when President John F. Kennedy enforced the interest equalization tax, which included a substantial 15% surcharge on foreign securities. This change led Soros to redirect his focus toward US securities, an avenue he hoped would be more profitable. Drawing from the tumultuous experiences of his youth and the philosophical teachings of Karl Popper, Soros began to perceive finance as a chaotic system, influenced by two key elements: reality and expectation. Soros proposed that a disparity always exists between these two elements, and it is within this gap that trading opportunities are found. He was convinced that there existed a reciprocal relationship between an investor's mindset and the markets they engage with. Soros once famously illustrated this concept with an analogy of walking down a street in New York City. If he was fearful of being robbed, he might become excessively wary, making him an easy target, leading to the very act he feared: getting mugged. Soros contended that the stock market may not function so differently. If investors are optimistic about a stock's potential rise and they all decide to invest, then the stock will indeed rise. However, once it becomes overvalued and a bubble is created, it's bound to burst eventually. This knowledge, which comes from what Soros calls the theory of reflexivity, presents an ideal opportunity for traders and investors to ride a boom while it's going up, but jump ship before the bust.
Let's rewind to 1974, when 17-year-old George found himself reading Karl Popper while studying at the prestigious London School of Economics. Karl put forth that no perfect knowledge exists. At the same time, George's economic professors argued for perfect knowledge and touted the efficient market hypothesis. These two ideas can't coexist, so which one is right? According to George, Popper is right, and a good thing for him, because if he didn't, he wouldn't be a multi-billionaire that he is today. After studying Popper, George had two key insights that were fundamental to him conquering the markets. One, investors are fallible. They make imperfect decisions based on incomplete information. And two, markets are reflexive. Investors' imperfect actions move the very markets they're a part of. And while this might seem like common sense, it has massive implications if you think deeply about it. It means that every market move has two components: an underlying trend based in reality and a misconception related to that trend. If you can spot a trend and its misconception, you're well on the way to understanding the markets and which trends are most likely to turn into megatrends.
And throughout the 50s and 60s, George applied this concept to achieve extraordinary success in the securities markets, wowing those around him and quickly gaining the attention of Wall Street. He had an uncanny sense for finance, intuitively grasping and understanding the logic of market movements. But by 1969, George was ready to use his tried-and-true theory of reflexivity to achieve something much greater than originally planned. He tapped into the network of investors he'd cultivated over the years, leveraging these relationships to fund the next step of his career. And it worked. In that same year, Soros was able to launch his inaugural hedge fund, Double Eagle. It was a bold move, especially for the time period. George Soros belongs to the first generation of hedge fund managers. There were only a handful like him when he founded Double Eagle, making this new venture particularly audacious. George's first move as a hedge fund manager, he made a bold prediction based on the reflexivity theory. He guessed that real estate investment trusts were on the precipice of a significant surge in value, but would crash in just a few short years. So, armed with $4 million of investor capital and $250,000 of his own money, Soros rode the wave of this trend. He was not a mere observer. He was a speculator, a player in the game. Soros made $1 million on the way up, and when the inevitable crash happened, he shorted them, accruing even more on the way down. Then, in 1973, Soros leveled up and joined forces with Jim Rogers, who he'd met while working at Singer and Friedlander. He renamed Double Eagle to the Soros Fund, which would later become the Quantum Fund. One of this team's primary focuses was on global macro investing, a strategy that would soon prove to be incredibly profitable. It involved pinpointing macroeconomic trends like shifting currency rates, variable interest rates, and significant political changes to make strategic investment choices. Needless to say, Soros and Rogers made for a powerful partnership. By the end of 1973, Soros's hedge fund was worth an astonishing $50 million. George's strategy, his insight, and his daring moves were finally paying off. Yet George's moves only grew more daring from here. In the 70s, for example, Soros had a hunch that the banking sector was on the edge of a boom. He saw that for a long time, banks had been considered stuffy institutions, bound by government regulations and uninteresting to investors seeking capital gains. However, George also perceived a shift in the wind. A fresh generation of bankers was rising as certain banks began to wield their capital with more audacity, delivering remarkable earnings performances for investors. In 1972, Soros penned a report titled The Case for Growth Banks, in which he postulated that bank stocks were on the brink of awakening. He encouraged his traders to buy as many shares as possible in major banks, and needless to say, his intuition was spot on. The shares soared by 50% in less than a year, generating a windfall of profits. In the first decade of the Quantum Fund, its total profits skyrocketed by 300%. It was clear by this point that Soros was not just a player in the game. He was a game changer, a force to be reckoned with in the world of finance. The name George Soros was quickly becoming synonymous with financial acumen and success. However, the late 1970s proved to be a decade of tumultuous economic upheaval that would threaten Soros's legacy. As hyperinflation gripped the United States, the once mighty dollar began to crumble, losing its value at an alarming rate. Unemployment soared, reaching unprecedented levels, and the nation was in the throes of a financial crisis. Amid this chaos, George Soros saw not disaster, but opportunity. He forecasted the occurrence of an inverted yield curve, a phenomenon where long-term bonds are more sought after than short-term bonds and stocks. And so, George made his move, going long on long-term bonds and short on short-term ones. But the economy, stubborn and resilient, held together longer than Soros had anticipated. While his initial prediction was correct, his timing was tragically off. The result was a devastating loss of $80 million, or 22% for his fund. Half of his investors withdrew their money, questioning whether this was the end of the line for Soros. George decided to retreat from the financial battlefield. retiring and leaving Quantum Fund in the hands of Jim Marquez and a team of managers. And under new leadership, the fund made a remarkable comeback, generating a 56.9% return in 1982. It seemed the Quantum Fund didn't need George Soros after all, and that his career in finance might really be over. But the following year, Quantum Fund saw a mere 9% gain under its new leadership, a disappointing turn of events. For George, this was like Batman seeing the bat signal pop up in the sky. It propelled him swiftly into action. In 1984, Soros emerged from retirement, returning to the helm of the Quantum Fund, and from there, he went straight to business, rescuing its reputation. His first order of business, capitalizing on impending doom. After observing the current economic landscape of the United States, George Soros believed that Reagan's politics would plunge the country into a depression. He found Reagan's adherence to market fundamentalism and the belief in the self-correcting nature of financial markets to be fundamentally flawed. It went directly against his own theory of reflexivity. So, George Soros decided to make a bold move and bet against the American economy. He took a long position on the Japanese yen and the Deutschmark while shorting the US dollar and crude oil. George's prediction proved accurate in 1985 when central banks began devaluing the American dollar. The United States currency plummeted by 13% and then a further 25% the following year. This strategic gamble resulted in a windfall of $150 million for Soros and his fund, proving that the king had truly returned to his throne. Of course, great challenges were still on the horizon. The 1987 financial crash was a pivotal moment in global economics, marking the end of an unstable and unsustainable worldwide stock boom. Soros, at the helm of the Quantum Fund, experienced substantial losses in this downturn, with the fund plunging by 30% following the market collapse. Once more, this caused George Soros to question the longevity of his prosperous investment career. Yet, it was on a day etched in infamy, the 16th of September, 1992, Black Wednesday, that Soros would orchestrate the most successful gamble of his career, one that would earn him the moniker, the man who broke the Bank of England.
Before we understand the trade, we need to understand the setup. In 1972, the European Economic Community currencies were pegged to each other in a scheme called the Snake in the Tunnel, which created a single currency band combining the currencies together. This slithery ERM did make it easier to transact across borders and paved the way for a single European currency, but it put pressure on each country's central bank and collapsed a year later. The UK entered the ERM in October 1990, agreeing to join with a fluctuation band of 6%. At entry, the pound sterling had 15% inflation, 3 times the rate of Germany, and low labor productivity. But joining House Slytherin wasn't a magic bullet. Over the next 2 years, the economic climate in the UK went from bad to worse as the economy continued to shrink with an inverted yield curve. And on the other end of the snake, again, Germany being the anchor, kept interest rates high, so demand for its currency stayed high. And if this wasn't bad enough, the UK had double deficits. The government was spending more than it was making from taxes, and it was also spending more on trade than it was earning. All of these factors weakened demand for the pound over time, forcing the UK's central bank to forego its foreign currency reserves and buy its own currency. The writing was on the wall, setting up one of the greatest trades in history. Starting in August 1992, Druckenmiller and Soros began building a position. The trade thesis was simple: the snake in the tunnel was unsustainable and the artificial demand from the central banks would eventually break. They started shorting the pound and the Italian lira. They would borrow these currencies from the banks to buy German marks while paying interest. The idea is that when the ERM broke, the currencies would drop relative to German marks and they would buy back the currencies at a discount, earning the difference minus interest paid as profit. On the 13th of September, Germany cut interest rates by 0.25% or 25 basis points, causing the Italian lira to drop by 7% in response. Around 10:30 a.m. on September 16th, 2 hours later, the British government made a fatal mistake. They announced an increase in the base rate from 10% to 12% to tempt speculators to buy pounds and cost the short sellers money. Their move backfired. It was clearly seen by the markets for what it was, an act of desperation. Traders smelled blood. They dumped pounds as fast as they could. The currency eventually devalued by around 20%, making short sellers a fortune, especially for George and Stanley, who had the foresight to see the inevitable and bet big.
This high-stakes, high-leverage maneuver was indeed Soros' most renowned accomplishment. serving as a prime illustration of his ingenious trading methods. Yet, it didn't signify the end of his endeavors just yet. George continued to tirelessly work for Quantum Fund and its investors for several more years, until his health became a concern. One day, in the midst of a frantic rush between banks, a sudden, sharp pain seized George's chest, hinting at the onset of a heart attack. His heart pounded like a gavel, each beat a verdict on his life's choices. The world of finance was a game, and he was a master player, but the stakes had suddenly gone too high. The numbers on the screens, once a source of thrill, now seemed hollow, devoid of meaning in the face of his own mortality. Soros stood there in the heart of the financial world, a titan among men, yet as vulnerable as any. It was at this moment he asked himself, why should I keep killing myself making money? In the midst of 2011's swirling financial currents, George, having navigated the high seas of high-stakes investing and concerned for his health, chose to sail into quieter waters. He reimagined his fund, once the game board of high-flying investors, into a family office, a refuge for his wealth and legacy. This was not a retreat, but a strategic pivot. The Grandmaster stepping back from the chessboard to contemplate a broader horizon. In this new chapter, George sought not just a successor, but a kindred spirit who shared his vision. Stanley Druckenmiller emerged not merely as an heir to a financial dynasty, but as a continuation of a philosophy. He was a man shaped by humility, yet his ambitions soared, his respect for George rooted in shared values long before their paths intertwined. George, whose name had become synonymous with a brazen bet against the British pound, had accumulated not only wealth, but also the influence to shape discourse. His true calling transcended financial markets. He was now a philosopher in action, his life's work an essay in the currency of open societies and the pursuit of a world unshackled by tyranny. The yield from his financial ventures was impressive, a staggering 20% annualized return across 4 decades. Yet now, George sought a different sort of profit. Social dividends measured in justice, democratic norms, and the upliftment of human rights. In 1993, the Open Societies Foundation sprang forth from George's vision. A homage to his intellectual lodestar, Karl Popper, the foundation became the instrument of George's will to shield others from the shadows he once knew. It was an ark, carrying his resolve across the tumultuous waters of global politics and social injustice. The foundation's handprints are seen in history's pivotal moments: the push of Czechoslovakia's Velvet Revolution, and the bolstering of South African students through scholarships during the suffocating era of apartheid. George's reach has extended from the thriving millennium villages in Africa to the war-torn streets of Sarajevo. His philanthropy, a testament to his youthful dreams now rendered into a vivid mosaic of global impact. Yet, a man of such power and impact always attracts enemies. Critics have thrown doubt on George's story of goodwill, claiming he has a hidden agenda. They accuse him of manipulating finances and wielding undue influence. But often, these claims are tinged with anti-Semitism, an old ghost used to undermine his life's work. Yet George's resolve is iron, shaped in the crucible of his past. The fusillade of criticism is but a whisper against the storm of his endeavors. His philanthropy is an unceasing march, a testament to a will that has weathered both the physical threats of Nazi oppression and the digital barrages of modern skepticism. As the pages of 2023 turn, the torch is passed to his son, Alexander Soros, a bearer of a new dawn for the Open Societies Foundation. He inherits not just the mantle of his father's empire, but the spirit of his activism. In the press's glare, Alexander pledges to deepen the ideological battle, his voice a clarion call for rights and democracy, a promise to champion the family's legacy. The narrative of George Soros thus weaves through the annals of finance and the tapestry of global activism, a life echoing the lessons of a childhood brushed by fascism, now carried forward through the voice of his progeny. His ledger is Wall Street's, but his story belongs to the world, a saga of struggle, resilience, and unwavering pursuit of a more equitable society.